All right, welcome to The Explainer. Today, we are going to tackle a topic that, let's be honest, can feel super intimidating: options trading. A lot of people hear options and they think it's just this complicated, risky thing, but we're going to completely reframe that. I want you to start thinking of options not as some kind of gamble, but as a seriously powerful toolkit. A toolkit that gives you leverage, protection, all kinds of strategic moves you just can't make with stocks alone.
So where do we start? Well, let's begin with what pretty much everyone is familiar with, right? Just buying and selling stocks. And look, it's a perfectly good strategy, don't get me wrong. But it's kind of like having only a hammer in your toolbox. A hammer's great, but it's not the right tool for every single job, and you really start to feel those limitations when you need to do something with a little more finesse. I mean, think about it with a stock. It's pretty straightforward. The stock goes up $1, you make $1. It goes down $1, you lose $1. It's a one-to-one relationship. Options? Oh, they completely blow that up. They're non-linear. They introduce this incredible concept called leverage, which means for a tiny fraction of the capital, your potential profit, and yes, your potential loss, can be seriously magnified. It's a whole different ballgame.
Okay, let's put some real numbers to this to make it sink in. Say you want to buy 100 shares of a stock that's trading at, let's say, $100 a share. Simple math, right? You've got to pony up $10,000. That's 10 grand of your hard-earned cash, all tied up in that one single position. All $10,000 are sitting there on the line. But now, check this out. Using an option, you could control those exact same 100 shares for what? Maybe $500. You heard me right. $500 instead of $10,000. You still get all the upside if the stock moves your way, but you've kept $9,500 in your pocket to use for other things. That right there is the magic of leverage.
So how is this even possible? Well, it all boils down to what an option contract actually is. Let's break down exactly what this thing is.
Okay, if there's one phrase you need to tattoo on your brain from this whole explainer, it's this: the right, but not the obligation. See, when you buy a stock, you own it. You're committed. An option, though, it's just a choice. It's a contract that gives you the right to do something, but you are never forced to do it. That little difference, that asymmetry, that's the secret sauce. It's everything.
And because it's a contract, there are always two sides to the deal. You've got the option buyer. This person pays a small fee, we call it a premium, to purchase those rights, to purchase that choice. And here's the cool part for them: their risk is totally capped. They can't lose more than that premium they paid. Then you've got the option seller. This person is the one who collects that premium. It's instant income for them. But in exchange for that cash, they take on the obligation. They're on the hook if the buyer decides to use their rights.
So right away, this brings up your very first strategic decision. It's not just about trading options. You have to decide which side of the coin you want to be on. Are you going to be the buyer, paying for a shot at a big win, or are you going to be the seller, collecting income for taking on risk? It's a fundamental choice.
And this quote just nails the difference in mindset. The buyer is paying for a lottery ticket, basically. They're betting on a big, dramatic move. They need something to happen. The seller, on the other hand, is more like an insurance company. They get paid to bet that things will stay, well, kind of boring. They win when time just quietly ticks by.
Now, here's the beautiful part. All those crazy-sounding strategies you might hear about, they're all built from just two very simple basic tools. First, you've got the call option. Think call up. This gives you the right to buy a stock. It's your bullish tool. You use it when you think the stock is going up. Then you have the put option. Think put down. This gives you the right to sell a stock. This is your bearish tool for when you think the price is going to fall. That's it. Call up, put down. Every strategy starts there.
Okay, so for the sellers out there, they have this amazing, almost magical force working for them every single day. It's called time decay, or theta. See, every option has an expiration date. It's like a melting ice cube. Every single day that passes, all else being equal, that option loses a little bit of its value. It just evaporates. And if you're the one who sold that option, that's fantastic. You collected money for it, and now you can just watch its value decay away, potentially letting you keep the whole premium.
All right, so we've got our basic Legos, right? We have calls and puts. We can be a buyer or a seller. Now let's get to the fun part, snapping them together to build actual strategies. How do we use these pieces to do cool things, like generate income
or go for big growth.
And here is maybe the best piece of advice I can give you. Please, do not get bogged down by all the crazy strategy names. Iron condors, straddles, butterflies. It's so easy to get lost. It's the #1 beginner mistake. Forget the names. Instead, just ask yourself one simple question. What am I trying to do? Am I trying to make some extra income? Am I trying to bet on a stock going way up? Or am I trying to protect the stocks I already own? Start with your goal and then find the strategy that fits, not the other way around.
You can create some really slick, defined risk setups just by combining these basic tools. Let's take an example. Say you think a stock's going up. Instead of just buying a call option, you could build what's called a bull-call spread. It sounds fancy, but it's simple. You buy one call, and at the same exact time, you sell another call that's a little further out of the money. Why do this? Well, the money you get from selling that second call helps pay for the first one, so your total cost is way lower. And here's the best part. It puts a hard cap on your risk. You know down to the penny the absolute maximum you can lose before you even click the buy button. It's a beautiful thing.
Now, what about those sellers who want income? They've got their own playbook. A few of the most popular strategies are things like this. A covered call is where you get paid for selling a call option on stock you already own. It's like renting out your stock for a little extra income. Or there's the cash secured put. This is where you essentially get paid to place a lowball offer on a stock you'd love to own anyway. You're getting paid to wait for your price. Pretty neat, huh?
Okay, so by now you can see how unbelievably flexible and powerful these tools are. But, and this is a huge but, like a chainsaw or any other powerful tool, they can be incredibly dangerous if you don't know what you're doing. And that brings us to what is, without a doubt, the most important part of this whole discussion.
Look, the secret to making money with options isn't about having a crystal ball. It's not about being some kind of market wizard. It's about being a disciplined operator. What's the difference between trading and just pure gambling? One word: a plan. A written plan that tells you what to do, when to do it, and when to get out. It is 100% non-negotiable.
So what does a good plan look like? Well, it looks a lot like this checklist. First, you've got to know yourself. What's your real risk tolerance? How much capital can you actually play with? Then, you pick just 1, 2, maybe 3 core strategies that actually make sense for you. Step 3 is the big one. You write it all down. I mean everything. Your exact rules for getting in a trade, for getting out, and for managing your risk. Then you test drive it. Use a paper trading account and see if it works without risking a dime. And finally, you analyze what happened, learn from it, and make your plan even better. It's a cycle, and a massive part of any good trading plan is how you manage your money overall. A disciplined trader is almost never all in. Just look at this breakdown. A big chunk of the portfolio is just cash. Why? Because cash does 2 things. It's your defense, it protects you when things go wrong. And it's your offense. It lets you jump on amazing opportunities when they pop up. Cash isn't dead money. It's your key to staying in the game for the long haul.
So, let's bring it all home. At the end of the day, this isn't really about the specifics of calls and puts. The big takeaway is that options are a set of professional-grade tools. The tools themselves are just tools. They work, but their success or failure, well, that comes down to the person holding them. So the real question isn't whether options work. The question you have to ask yourself is this: are you prepared to be a disciplined builder? Are you ready to create that blueprint and follow it every single day?